Good afternoon and welcome back to the 8th in our expert speaker series for the real estate sector from Goodbuddy for 2021. Just to give you all a bit of time to log in and get set up. And we're delighted to have a very strong audience signed up today. Over 100 people have registered from a wide range of property markets and property sectors and most importantly, geographies. Our expert speakers this afternoon are from TWM. TWM are a specialist advisory agency based in Dublin, but also with a strong focus on the Galway market and the regional investment market. But before I introduce our expert speakers, I'd like to run through with you some sort of key themes and key slides, which we've been looking at the overall Irish regional property market. And as I said at the start, the whole focus today for the next 30 minutes or so is to run through, what is the performance behind the Irish regional property market? What are the drivers? What are the key trends to observe? And what are the opportunities in terms of the routes to play this from an investment perspective? So, Russell, if I can ask you just to jump on to the next slide, please. Thank you very much. So look, only one slide for me because again, you're here to hear from our experts in TWM, but I just want to really highlight a couple of interesting trends, which is down to sort of the foreign direct investment story within the Irish regional property market, but also the broader Irish economy. And if we think about broadly the occupier base outside of the core Dublin area, you have a very significant concentration of major multinational foreign direct employers, but also government and state-backed tenancies or state-backed organizations. So when you think about how they've performed and how they've evolved over the last 2 years, you can see in that dark blue line or the navy line how significant the growth rates have been in regional and FDI-related employment levels. And that momentum has continued unabated right the way through 2020. Whereas if you look at the remainder of their economy, the non-FDI side, how considerably weaker that has been, particularly as we hit the initial COVID hurdles. So this is a message which really sort of focuses on the occupier base in these regional property markets. If we think of the main employers, the main driving forces behind taking up space, it has been very much in this FDI story, which gives considerable comfort in our view around income streams, but also in terms of tenant covenant, particularly when you compare it to competing locations across Europe or even in major cities. So look, without further ado, I just want to introduce our expert speakers for the next 30 minutes or so. As I said, they are from TWM, and we are joined by Michele Jackson, who is a director and co-owner of TWM, Russell Clear, who's a senior investment analyst, and Rory Wall, who's a surveyor at TWM's Galway office. And over the next 25-30 minutes or so, they're going to be bringing us through a broader macro picture on the Irish regional economy, and particularly how that relates back to property, a look at some investment deals in the commercial property space, and particularly analysing how pricing and trends have evolved in terms of the appetite for our capital allocations, a bit more of a deep dive focus then on the occupier side, and a run through some specific deals on a regional basis. So without further ado, I'll hand over now to Michele, Russell and Rory. You're very welcome. Thank you.
Thanks, Colin. I'm just going to run through at a macro level a little bit of information on Ireland and the regions, and apologies, I do appreciate I've got plenty of locals listening in on this, but also an overseas audience, so I just wanted to put some context on the population. So we're estimated at the moment the population of Ireland is just under 5 million people. We were due to have a census next month, but that's been postponed because of COVID to 2022. So this population growth rate since our last census is up what's estimated to be 1% per annum. A key feature of Ireland is we have the youngest population in Europe, with an estimate that 33% of our population is now under the age of 25. And we're forecasted, based on our current growth rates, for the population to hit 5.75 million for 2040. So looking at the 2011 to 2016 census and the growth and where and what happens there, as I said, it was a steady increase of 1% per annum, with Dublin and the suburbs exceeding that. And then the key regional centres, Cork, Galway and Limerick cities, a combination of growth rates there. But I think an important point here is, that other key regional locations such as Athlone, Waterford, have also had the benefit of those proportionate growth rates. My next slide is just, I suppose, again, apologies to the locals, but it was just to show where those 4 regional cities are and the infrastructure and the development that's happened over the last 10 years and how key that has been in terms of connecting. You can see Athlone in the Midlands, Kilkenny, Waterford, Letterkenny, and how those cities have now been connected by road, rail, their proximity to ports, airports, which are all critical for the FDI and the locations. If you just go on to the next one, Russell. I think, as everyone will appreciate, employment is going to be a key driver for the regional centres and for retaining and attracting population growth. Ireland is currently the fastest growing economy in Europe and the only native English speaking country that's a member of the EU. So for us and for occupiers looking at Ireland, some of the key points for the regional locations, aside from the cities, but the other major towns around Ireland for driving and retaining these growth rates, is the supply of skilled workforce, the proximity of third level institutions, of which a lot of our regional towns have a presence, the supply of the business accommodation in those towns, which is well supported by the Irish Development Agency, with grants and accommodation, good quality affordable housing, and again the quality of life that can be achieved for people working in regional Ireland is a key factor for employers and retention of skilled workforce. The infrastructure and the accessibility now has improved dramatically over the last 10 years to include the rollout and high-speed broadband, and also then for a lot of those multinationals, basic things like the supply of hospitals, hotels and facilities for organisations locating there are critical. So I'll just hand over to my colleague Russell, who will just give you some high-level information in relation to the real estate investment market.
Thanks, Michelle, and thank you, Colin, for the opportunity to be part of this discussion today. As mentioned earlier, I'm a senior investment analyst with TWM. As part of my role, I've reviewed the 2020 investment market, as can be seen on the next slide. The standout figures for 2020 are that a total of 3.057 billion was transacted in 2020. Despite the COVID-19 pandemic and government restrictions that were in place, this was still above the 10-year average, which stands at 2.851 billion, showing a positive year overall in terms of activity. When we looked into the source of funds, we found that 78% of the investment activity was from overseas investors, while Irish investors accounted for 18%. The most dominant sector of 2020 was the office sector, accounting for 39%, followed closely by PRS at 38%. The average deal size in 2020 was 28 million, down considerably from 2019, which was reported at 42 million. It should be noted that when the Green REIT 1.5 billion sale in 2019 is removed, the average drops down to 33 million, which is closer in line to the 2020 figure. In terms of location of investments, Dublin accounted for 94% of the transactions. This is likely to be higher when transactions with confidential locations are taken into account. On the next slide, we'll have a look and see how this compares to previous years. As you can see, the percentage of regional transactions for 2020 was considerably below previous years. The average going back to 2015 stands at approximately 11%, with a peak in 2017 of just shy of 20%. On the next slide, we'll take a deeper look into the regional transactions for 2020. There were 26 regional transactions reported in the 2020 investment stats, 17 of which were over 1 million in value, equating to a total volume of approximately 70.5 million. The most dominant sector in 2020 was the retail sector at 73%, followed by the office sector at 13%. The retail sector was boosted by a number of supermarkets and shopping centre transactions in 2020. In terms of most active regions, Galway and Cork accounted for 44% of the regional transactions. And at the end of Q4 2020, there was approximately 1.85 billion of investments on the market throughout Ireland, with approximately 165 million located in regional Ireland. I would note that there's likely significantly more available when off-market opportunities are taken into account, particularly for professional buyers. On the next slide, we'll go through some of the regional transactions that were completed in 2020. First transaction we're going to look at is an office investment. It was the IDA Business Park in Johnstown, Navan, County Meath. This was an office investment, an office building extending to about 30,000 square feet. It was fully let to An Garda Síochána, which is the Irish state body, and it transacted for 5.65 million, resulting in a net initial yield of approximately 7.3% after standard acquisition costs of 9.92%. The capital value equated to approximately 188 per square foot. The next transaction we'll look at is an industrial transaction. It was the Rye River Brewing Company in County Kildare. It was an industrial unit extending to approximately 61,000 square feet on 4.9 acres. This was a sale leaseback to Rye River Brewing, and it transacted for 3.3 million, resulting in a net initial yield of approximately 7.1% after standard acquisition costs of 9.92% and a capital value of approximately €55 per square foot, which would be below replacement cost. The last transaction we'll look at is a retail grocery store. This was actually a TWM sale. It was a purpose-built supermarket of approximately 46,500 square feet, fully let to Tesco Ireland on a 35-year lease from July 2011 with break options in years 15, 20, 25 and 30. This transacted for 7.8 million, resulting in a net initial yield of 11.1% after costs and a capital value of €167 per square foot. I'm then going to transfer over to Rory in the Galway office, who will bring us through a bit of a Galway city focus and some of the other transactions.
Thanks, Russell. My name is Rory Wall and I'm a surveyor based in our Galway office. I appreciate that a lot of you are familiar with Galway City, so the following slides will give context to our overseas viewers on why investors want to come to Galway. So firstly, Galway has everything you need except the sunny weather, unfortunately. Galway is positioned on the west coast of Ireland, approximately 2 hours by motorway to Dublin and 1 hour and 15 minutes by motorway to Limerick City. Galway is the fourth largest urban area in Ireland and is the primary commercial, cultural and administrative centre in the western region, known as Connacht. There is excellent public transport links to Dublin, including a regular train service which takes approximately 2 hours and 20 minutes and stops at large regional towns such as Athlone and Tullamore en route to Dublin. There are regular bus services to Dublin City and express services to Dublin Airport, providing unparalleled accessibility to the capital. Shannon International Airport is located 1 hour south of Galway City, providing flights to North America, such as Boston and New York, the UK and major cities in Europe, while Knock Airport is located 1 hour and 15 minutes north of Galway City, providing flights to cities such as London, Edinburgh, Paris, Barcelona and Dusseldorf, to name but a few. Another key driver of economic activity in Galway is the port, which allows up to 6 by 6,000 tonne vessels into the inner dock, with approximately 600,000 tonnes of cargo going through the port annually. There are plans in the pipeline to expand Galway port to facilitate larger vessels and free up inner harbour lands for development. So Galway has the advantage of 2 third-level institutions, including National University of Ireland in Galway and Galway Mayo Institute of Technology. There are approximately 25,000 students located in the city. Both institutions target the local market with a strong emphasis on providing courses such as science, technology, engineering and mathematics, or STEM courses. There is a diverse employment base in Galway with a mix of professional, commercial, industrial, ICT, medical, educational and state bodies. The majority of business and industrial parks are located in the eastern suburbs in the Parkmore and Ballybit regions. Major employers are located in these areas, including large pharmaceutical and IT companies such as Boston Scientific, Medtronic, Celestica, Hewlett-Packard, EA Games and SAP. Boston Scientific, for example, is the largest employer in the city, employing approximately 4,000 people, is one of the largest exporters in both Galway and Ireland, with exports valued at approximately €4 billion. Galway City has high-speed broadband with the advantage of 4 hospitals, including both public and private. The average house prices in the city is 317,000 and 209,000 in the county, compared to the average house price of 383,000 in Dublin and 261,000 nationally. So the next two slides I'd like to show you are two properties that TWM sold in Galway City. The first was an industrial and office sale, which was Building 3, located in Parkmore Industrial Estate. This sale proved very popular with investors due to its strong tenant covenant, the length of the lease remaining until 2042, no break options, and its upwards only rent reviews. There were 8 offers placed who were all cash buyers based locally and nationally. The building sold just over €6 million at a net initial yield of 6.6% after standard purchase costs were applied. The next sale were 2 office units located in Ballybrick Business Park opposite Boston Scientific. This also proved very popular with investors due to its location, attractive capital value of €85 per square foot, which is significantly below build cost, and the increase of rental income upon letting the vacant space. There were 5 offers placed by both debt and cash buyers. The property sold for €1.7 million last year, €225,000 over the guide price. The net initial yield was 2.46% and the reversion yield of approximately 10%. So I'd like to pass you back to my colleague Michele Jackson, who will talk you through the Irish investment market outlook.
Thanks, Rory. So just looking, I suppose, at the overall Irish investment market, the TWM view is we had a relatively buoyant 2020 despite COVID. As Russell highlighted, turnover was above the 10-year average, and we do expect this to continue, and we think Ireland is very well positioned there. Real estate as an asset class, with negative deposit rates, the fact that you're buying into a tangible asset that people can sort of touch and feel, and the returns that are being offered at the moment relative to where our 10-year government bond yields are, which negative at the moment, and where the gap between the old property equivalent yield is and bond yields. There's an expectation that there's a risk premium between the two, whether that's 300-400 bips, and at the moment it's carrying it over 500, which is on an all property basis, higher than that in certain regions, and that is seen to be a strong factor for attracting capital. For many people looking at property, the opportunity is the moment in time, but also the security of the income and the value of the income, and particularly where the rent has been paid and there's good rent collection over the last couple of years, and particularly last year, that people will get a sense that if people can survive and pay their rent through last year, then they're buying into essential real estate, and they can get comfortable with that. And we see very, very strong demand where you've got that strong covenant. Particularly things like the supermarkets had their day last year when they came to the forefront as essential real estate. I mean, an interesting dynamic for the regional real estate is with the supply of finance and maybe alternative finance that's available, the yields can be very, very attractive in terms of the yield gap between cost of debt and returns that can be achieved, which we've seen attract new entrants into the regions, including overseas. If you just want to, I suppose, again, for the benefit of people maybe not familiar, looking back over the last 10 years in the Irish market, and I remember well in 2010 selling regional bank branches where bond yields were ahead of the yield on the investments I was selling, and the challenges of doing that versus today when we look at, as said, the yield gap of over 500 bips. I think one important point for the regions has been the impact of COVID. It's obviously been an unprecedented year, but we do see that this will be an opportunity for regional cities and towns to attract business. There's no doubt that the office is an important place where people collaborate, people train, people work, people are based. But we do see that there'll be some level of flexibility likely for a lot of organizations in the future. And this could create regional hubs and really strengthen those locations, because remote working has now been proven to work in part for certain sectors, and maybe co-location is going to be an option for organizations. you know, regardless of whether it's a regional city or regional town or Dublin, offices, you know, are not just a place for work. You know, they have been seen to, you know, a lifestyle that attracts young people that want to come to a place and get together and collaborate. And we see a lot of regional cities offers a lot of what Dublin offers. What we have found in the regions where, particularly for offices, where there's less speculative development, a minimum level of rent is needed to sustain and justify development commencing. And, you know, often occupiers appreciate that, particularly for the higher spec and medical uses, and understand that maybe a longer lease is needed to help stack up the development. And this can be, you know, very attractive for investors who maybe are getting lease lengths longer than they, you know, they might be able to get in some of the capital cities. It's not just, I suppose, the rent for occupiers. They're also looking at their all-in costs, rents, rates, service charges, which, you know, brings their overall occupancy costs down. And we do see, and you know, Russell pointed out the sort of level of activity last year in the Irish market, but we do continue to see strong demand for regional product. And maybe it's a case that buyers don't tend to trade the assets as often as in some of the capital cities. So, you know, sourcing and finding good quality product, you know, can be the challenge rather than demand for it. So that's, I think, a sort of a snapshot, a high level overview of it. Colm, I'll hand back to you.
That's absolutely perfect. Thank you very much. And Russell, if you just knock off the shared screen, and we'll go back on the video. Thank you, the three of you, Michelle, Russell, Rory. It was really a great whirlwind tour through the sort of the regional Irish property market, but also the underlying economic drivers behind it. If you would like to ask a question, for those of you on the line, there's a Q&A dialog box at the bottom. Just you can type in your questions there, and we can get to them one by one. But in the meantime, there's a couple of questions that have come in separately, just in terms of some property specifics and some broader market views, which we could perhaps sort of run through over the next couple of minutes. And Michelle, you mentioned it towards the end of your presentation in terms of, you know, the operational performance of a lot of the regional Irish assets and the occupiers has been very robust over the course of 2020. Obviously, really a testing year broadly when it comes to business models. You know, rent collection has been robust. You know, Ugrove have, you know, reported consistently 99% plus on a quarterly basis. But also that comes back to perhaps the types of occupiers that would dominate, you know, regional property, Irish property markets, be it, you know, the semi-state or direct state, as we've seen in Russell and Rory's presentations, the occupier base, but also the major multinational occupier base. And I just wondering if you sort of thoughts on, I suppose, covenant strength in a regional Irish property market perspective, and maybe this is one for you, Michelle, and thinking about sort of the types of occupiers and I suppose in particular, you know, the relatively low risk nature of those income streams.
Yeah, I mean, as you say, you know, 2020 was a test of a lot of those occupiers, and probably Rory, you know, gave an overview in terms of Galway, and people may be surprised at the quality of the tenants that are, you know, there in numbers, and, you know, very, very resilient, very strong covenants, and you know, those particular investments, you know, do attract very, very strong interest, and Rory was showing a few of those for that very reason, Colm. You know, the rent payment history is on the nose, and, you know, we sometimes find when those investments come from sale, you know, the occupiers themselves become one of the parties interested in trying to, you know, protect and secure rights by buying in the investments themselves. So, you know, that is most definitely, and as you mentioned, the state, the OPW, you know, they also tend to be in lots of the regional towns. And, you know, I think particularly where there's state departments, when they move to these towns, you know, we don't see much evidence of them relocating. You know, that's often a question somebody will say to me, what happens at lease expiry? You know, who else is there to go into the town? You know, if it tends to be the only building in the town the state could occupy, you mightn't necessarily have the same threat or competition to attract them at lease expiry to another building in the town.
Mm-hmm. And maybe just to bring Russell in on that point in terms of as we look towards expiry. And Russell, one of the themes that was quite apparent in your analysis of a couple of transactions was the fact that we're still seeing a lot of these assets trading below replacement cost. And obviously in terms of where rental values are versus you know, what's potentially viable for new development. Given that we are below replacement cost for a lot of these transactions, and that headline rents perhaps aren't enough to encourage speculative development, does that, in your view, sort of limit any risks around oversupply? And again, get back to that point Michele mentioned, whereby if there's a limited enough choice of assets in certain locations, it considerably de-risks the point around expiry.
Yeah, absolutely. Until the rental rates achieved in these areas are high enough to secure speculative development, we see that the risk is limited on a lot of these investments where the state might be in place. Upon lease expiry, the chances of them vacating is quite slim.
Okay, and maybe just Rory, just obviously bringing through the sort of the Galway market and thinking about some specifics. I don't want to put you on the spot in terms of rental levels, but it'd be just interesting to understand the sort of the value dynamics that come into play. So obviously there's when a company is looking at these overall occupier costs, certain locations are more competitive than perhaps paying 55 or 60 quid a foot for prime Dublin space. What sort of broader ranges are you seeing from a pricing perspective now for prime offices in Galway?
Yeah, so we're seeing the new Bonham Quay development in Galway City. We're seeing rents around the €30 per square foot that are achieving. We carried out a rent review recently on a large 50,000 square foot office development, and we're achieving rents of €21.50. So in suburban areas in Galway, like I mentioned in Parkmore and Ballybrit, we're seeing rents achieve in excess of €18 to €20 per square foot for LEED gold type buildings, and €15 per square foot approximately for good spec office space there. So there is good there's good development there, so we're seeing positive signs.
And maybe just obviously you referenced Bonham Quay, obviously a landmark development for Galway, one of the first of the sort of new generation buildings that have emerged since the crash in the city. And if you think about demand for the sort of the uniqueness of those scale assets, in terms of your expectations, again, these are buildings that will appeal on an international basis, I suppose, as much as they would appeal on a sort of a governmental basis. Would that be sort of correct in terms of the expectations around that?
Yeah, but we're seeing strong demand for LEED gold type space in the city centre, and occupiers are willing to spend for this good spec building. Like I mentioned earlier, that there's reported that the occupiers are achieving €30 plus for space, for large space as well.
And maybe just if time for one more perhaps question, just pulling up in terms of a question from one of the people on the line asking about expectations around investment pricing, investment returns and demand. And maybe one for you, Michele. Obviously, you're thinking about the types of investors who've gotten involved in the regional property markets. Are you seeing increasing levels of international interest, given that obviously the early stage recovery was mostly Dublin centric? Are these international investors venturing beyond the M50?
Yeah, absolutely they are. I mean, I think when somebody comes to Ireland, their first investment, will typically be within Dublin, unless they're a specialist investment house that goes there. But yeah, we're definitely seeing, certainly Cork has had a very strong demand. And it actually one of the reasons I think they haven't been more successful in acquiring is the locals can often be more competitive for their own assets, or an occupier looking at them. Whether it was the supermarkets, we sold Tesco and Grory, and again French institution there. So yeah, we once you have when people are looking at it on a like-for-like basis, and they can see this is a covenant that I can buy, I'm familiar with it, it's a PLC, I understand it, and here's, this is the rent they're paying, this is the rental payment history, and this is the yield compared to Dublin or compared to Manchester or wherever it's been compared to, and they can get comfortable around the dynamics of the fundamental market and how it, how it works. We've seen second and third investments happening regionally, and as I said, its supply has been one of the constraints on figures column rather than demand.
And I'll say, just thinking about the next steps for that then, Michele, obviously the more international professional investment we will have in the regional locations will hopefully lead to increased transparency. in terms of understanding where we are from comparable transactions, comparable rental evidence, but also pricing more broadly from a risk perspective. And obviously, if you look at with the listed sector emerging in Dublin initially, we saw a considerable injection of transparency there, and obviously it's put it very much on an international footing. So you'd imagine similar trends could begin to emerge in the regional markets as well, hopefully going forward.
Yeah, I mean, I think so. I think the more transactions that happen, the more transparency that'll come with that. So, if we continue to see occupiers strengthen those locations, and maybe, it doesn't, our stamp duty doesn't help in a way, Colm, because it deters people from trading as often as they might otherwise do. But yeah, certainly, more institutional investors, the more public that information will be.
Okay, and on that note, and on that positive outlook, let's just end and thank our speakers particularly. So Michele, Rory and Russell, thank you very much for your time this afternoon. To the 100 or so who joined us live on the call, it was a great pleasure to have you all back for the, as I said, the 8th in our expert speaker series. We have now had nearly 1,400 people attend over the course of the year. So thank you for your support. And if you do need any of the recordings or the presentations, please do feel free to get in touch. But apart from that, have a very good afternoon. And if you're in Dublin or London, enjoy the fine weather. Thank you very much.
Great. Thank you.
Thank you.
Thank you. Thanks, Colm.
Thank you.